In this week's video, we'll review the latest charts to help us answer the question, what's next for stocks and how can we best navigate in volatile markets? It's a chart of interest rates or the 10-year yield as of the close on Friday, March 5th. This is the original area that we were watching. This is another area of potential resistance. We're inside of this box. However, if we think outside of the box and think about what this move is, it's a retracement of this decline or this A to B move. 10-year yield closed right at the 38.2% retracement of that A to B drop during the COVID crash in the stock market. This line may act as resistance. That's why we refer to all resistance as potential resistance. Here's the tweet from February 22nd that we covered in last week's video. We did undercut these levels intraday this week, but we rallied during that session. The lowest close was 37.68, which was above 37.61. As we noted last week, there's nothing magical about these levels. It's just good to establish logical reference points to manage against. There's a comment on Twitter from one of our followers, 4:32 p.m. Eastern Time, after the close on Friday, March 5th. As it turns out, we did record this week's video after Thursday's close. And as it turns out, we don't believe we have to re-record any of it. It can be constructive to understand and listen to commentary after Thursday's close. The S&P 500 dropped 51 points during that session. We should be able to review the charts as of Thursday's close with a flexible, unbiased, and objective, open mind. Thus, these data points on the screen can help you as you watch this week's video to understand what happened during Friday's session. Here are the charts we're going to cover. This is what happened during Friday's session. For the week, the S&P 500 finished in the green. The NASDAQ was down. That speaks to rotation that we'll cover in this week's video. Broad NYSE composite up for the week. The VIX down for the week. This portion of the video covers the commentary as of Thursday evening. At the end of the video, we'll link back on Friday to provide a quick summary. It's a breadth indicator based on the NYSE composite on the right side of your screen. This is another form of a breadth thrust here. It was nailed down at the end of February 2021. Only two previous times after the 1987 crash have we moved rapidly from the lower blue line to the upper blue line. Second time after the financial crisis low where my cursor is, 2009, a breadth thrust to the upper line. Only the third time dating back to 1987, rear view mirror after the COVID low, and it was nailed down as of the close on February 26, 2021. Longer-term S&P 500 performance was satisfying, yet a little bit erratic in here. Average gain 3 years out, 30%, 4 years out, over 45%, 5 years out, over 60%. Left side of the table helps us with maintaining a topic we cover every single week in these videos, maintaining realistic expectations about how markets operate in the real world. If you know your market history, anything that happened after the 1987 crash from a long-term perspective is bullish. Anything that happened after the financial crisis low is bullish. And yet, it doesn't mean the stock market went straight up or went up every single day. Mixed performance looking out 3 months, 6 months, and 9 months. If you didn't overreact, very good things happen longer term. Maximum drawdowns, they typically didn't come until later. This is somewhat of a Nordique setup here. Worst case scenario, 186 days from the date of the signal, which would be similar to making a low at the end of August 2021. We would hypothetically backtrack to 3,600 on the S&P 500 index. If you follow the financial markets, you're hearing a lot about rotation. Here's an example. Value, VTV, relative to VOO, the standard weight S&P 500 index. This is a relative chart, several months of consolidation. It looks like we're trying to get a breakout in favor of value stocks. What does blend mean? Blend means the S&P 500 has value stocks and growth stocks. And since we know there are two sides to every coin and two sides to every story, we can flip this chart. And from this perspective, it tells us it's possible that VU could underperform VTV going forward. As we always say, these are relative charts. That doesn't mean VU is headed for disaster. It just means it may underperform. It had a long-term period of rare outperformance here. It's possible it needs to give some of that back. We also know this is a failed bullish breakout here. This could be a failed bearish breakdown. The longer the breakdown remains, the more relevant it becomes. It might be helpful to see a visual of what rotation means. It's referencing sector rotation. This is the weightings for VTV, the value ETF. This is the weightings for VU, the standard S&P 500 index. This is the difference between the two. If VTV is starting to outperform VU, it's telling you that some market participants are starting to shift over to these weights from these weights, and these are the type of changes that they're making. Similar concepts apply to growth versus the blend S&P 500. From a probability perspective, this long-term consolidation pattern appears to be resolving itself to the downside against VUG relative to SPY. Once again, this is a false bullish breakout here. It is possible this is a false breakdown. The longer this breakdown remains, the more relevant it becomes. The situation is similar for the NASDAQ 100 relative to the S&P 500. However, it's a little bit more mixed and not as dire at this point. This rollover here is still within the context of this consolidation box, and we'll have to see how it plays out. This also speaks to sector rotation. Energy has been very strong since the U.S. election. Shorter term, it's in an uptrend relative to the stock market. Longer term, it still has some work to do. We'll see how this plays out over the next few weeks. Similar situation with financials. The probability of it outperforming in the shorter term is increasing. Longer term, we'll have to see how it plays out. This is a chart that we covered back on January 22nd. Why would we cover a chart like this back in January? Because we know with 100% certainty a bullish trend is going to backtrack at some point. The purpose was to give us some reference points, psychological reference points, before the market backtracked. If we look at the same chart as of the close on Thursday, March 4th, nothing too alarming yet. We held here twice in January. This is the intraday low here. This is the intraday low. The darker line is the closing lows. We did close above the thicker line here as well. We'll have to see how this plays out on Friday and in subsequent sessions. But right now, we're above these upward sloping trend lines. We're still holding above the January lows, and we're still holding above these levels that we noted back in January of this year. If we hold above these levels going forward, it tells us something about bullish probabilities. If we don't hold above these levels, it tells us something about increasing bearish probabilities. This is a summary table of studies that we covered on January 15th, where it said good things could happen for a long period of time, but we had to keep an open mind about the way markets operate in the real world. We showed this chart dated January 15th and said based on history, it wouldn't be abnormal for the S&P 500 to backtrack to any one of these levels. How does the exact same chart look today? While it hasn't been a lot of fun in here from a historical perspective, we really haven't done anything that's out of whack with the historical script yet. When we covered this back in January, If you were watching the video, you probably thought, yeah, that makes sense. The market could backtrack to one of these levels. It's a lot harder for it to seem to make sense when it's happening. That's the whole purpose of the reference points. In one of the historical cases, we backtracked all the way to 3,500. Not a prediction in any shape, form, or fashion. These simply help us better understand the probability of good things happening relative to the probability of bad things happening, and we can do that within some reasonable and prudent historical context. Also noteworthy, as of Thursday's close after the 51-point drop, we are still above an upward sloping 100-day moving average and still above the 200-day moving average. We are now 20 calendar days removed from the peak on February 12th here. Might be helpful to know, how did the exact same chart look with the same moving averages 20 calendar days after the peak in February of 2020? Was price still above an upward sloping 100-day? And was price still above an upward sloping 200-day? The answer is absolutely positively no. 20 calendar days after the February 19th peak here, the chart looked infinitely worse. This is hot knife through butter through the 100-day, hot knife through butter through the 200-day. That's not what we have in the present day as of Thursday evening. This is a much more orderly decline thus far. There's a lot of information on the screen here. We'll walk through it. It's all very easy to understand. Here, where my cursor is, upper left-hand corner, we are now 13 trading days removed from the peak. That's as of Thursday's close. And over those 13 trading days, IEF has outperformed SPY by 1.45%, which tells us something about economic fear. If we look at the same situation, 13 trading days from the peak in February of 2020, the rate of change over those 13 days, IEF relative to SPY, blew this figure out of the water. This is economic fear on a big scale, 32.26%. And yes, the two situations are different, but this does tell us a lot about what's happening in the market. In the present day, it's not fear about an impending recession. It's not fear about the economy. These are different situations with different drivers. This is weekly sentiment data. Sentiment was pretty bullish up here recently, and then it dropped all the way down to this level on February 19th of 2021. We have data going back to 1997, and a move like that has only happened 7 previous times. And again, we're looking at all of the data. In every single case, from the date of this signal, the S&P 500 was higher. The average gain was 14%. The median gain was 13.27%. The date of the signal in 2021 was February 19th. In these historical cases from the date of the signal, the average 12-month drawdown was about 6.5%. The median drawdown was 4.4%. For the purposes of managing risk in the short term, we would prefer to look at the drawdowns over the next year that occurred relatively soon. In this 2019 case, the maximum drawdown did not come for 178 calendar days. For our purposes, this one's not particularly helpful because we would be managing risk well before a decline like this. For us, this is what's helpful. Here are the other drawdowns hypothetically on a 2020 chart as of March 3rd. If we experienced a similar drawdown to many of these cases here, this is what it would look like on a present-day chart. One of the cases in relatively short order came all the way back hypothetically to the Vaccine Monday high here where my cursor is, and that's all the way down around 3650. This is the chart as of Wednesday's close. Here's the same chart as of Thursday's close. Not seeing a big variance in any way from the historical script. If we drop into this area here, we'll learn something about bearish probabilities. So walking forward, we still have the January lows as a reference point, the Vaccine Monday high as a reference point, and the September high as a reference point. And these maximum one-year drawdowns align nicely with all of those levels of possible support. The recent shift in sentiment once again tells us to try to keep a longer-term focus here as long as the data allows. And these drawdowns, 100% normal and to be expected even within the context of the strongest bullish trends. And these lines on the screen here, one of them is all the way down at 3650, help us maintain realistic expectations about how markets operate in the real world. It's very, very difficult to make money if we have unrealistic expectations. Here's a maximum drawdown chart that we covered in last week's video. Have we exceeded the levels that we showed last week? As of Thursday's close, the answer is no. Came down intraday and tagged these levels. There's nothing magical about these levels. They just help us assess probabilities. Last week, we noted that the January lows were relatively important as a reference point. During Thursday's session, the NASDAQ came down and basically revisited the January low. This is as of Thursday's close. We'll learn something if price moves into this area here and stays in this area here, and we'll learn something if we bounce and move in this direction. Right now, as of Thursday's close, the January lows have held. However, on a relative basis, the NASDAQ is looking a little bit vulnerable here, but this is still an area of congestion in here. It's possible we could still bounce here, but this is telling us to be open to NASDAQ underperformance in the short term. The concept of a breadth thrust is a fractal, can also help us on shorter term time frames. This is a little bit of a mini thrust here in September of last year, a mini thrust here late October, early November of last year, a similar move this week on March 1st. In the two previous cases, this is the S&P 500. This happened near the September low and near the October-November low. This move here simply speaks to odds. This is a weekly chart, breadth indicator showing the percentage of NYSE stocks above their 200-day exponential moving average. In the last 34 years, we have data going back to roughly 1987. Only 3 times has the market been this oversold. COVID low here, financial crisis low here, and after the 1987 crash. Given this is the only time in the entire data set that we've moved from the red line to the upper blue line and done so in a rapid fashion. Based on this indicator, it's pretty easy to make the argument this is the strongest breadth thrust in the entire data set covering 34 years. This is the S&P 500 on the bottom of your screen, and in the 2 previous cases, good things happen for a long period of time. Long period of time was measured in years, and yes, there was a ton of gut-wrenching volatility between point A and point B. A ton of gut-wrenching volatility between point A and point B. We've covered this concept in a recent video, so we will move quickly. Midcap, new 52-week lows. S&P 500 is peaking here. You can see new 52-week lows start to expand. Yellow flag. Here, after the major low in 2003, flat line. After the major low in 2009, flat line. Present day, flat line, even after Thursday's session. This is after the close on Thursday, March 4th. Nothing particularly alarming here yet. Everything that we just said about the mid-cap chart applies to the NASDAQ 100 chart as of the close on Thursday, March 4th. Flat line. You can pause your video player and look at this chart closely. This one is telling us to pay a little bit more attention. It's expanded a little bit relative to the rally off the low. However, it's not a showstopper. Look in here how far the market moves between January 1st, 2013 and May of 2015. This is the S&P 500. And we get several expansions of the lows here. So there are some pay attention things here. It's a higher high. But the point of the exercise is this doesn't look anything like this when really bad things happened. And this doesn't look anything like this when really bad things happened. And this doesn't look anything like this when really bad things happened twice. This data includes a wide variety of securities that trade on the NYSE Composite. This version looks at common stocks only, and in this case it looks even better. As of Thursday's close, flatlining. Small caps, ditto. Thursday's close, flatlining. What does this look like? It looks most like this period here after the major low in 2009. You can pause your video player. Ryan Dietrich, this is the data as of Monday's close. Helps us with realistic expectations. Notice, next day, 1 month later, 3 months later, a lot of red in Ryan's table. However, 6 months later, a lot of green in Ryan's table. To capture the green in Ryan's table here 6 months later, average gain almost 12%, you had to withstand 100% normal and to be expected volatility. There's no free lunch in the financial markets. It's been 49 weeks since the major low in March of 2020. This is the PE multiple on the S&P 500. This is the 49-week rate of change. We've never seen an expansion like this, with a couple of exceptions. Here, near the major low in 2009, here near the major low in 2003, and here near the major low in 1982. And in this case, we had significant multiple expansion for roughly 18 years. PE ratios have been expanding. Yeah, that's true. They were expanding after the major low in 1982. PE ratios have been expanding. That's true. They expanded after the major low in 2009 as well. PE ratios have been expanding. In this case, they really expanded before the major low in October of 2002, but this is still expanding for the same reason. Market participants are seeing the other side where the economy will recover. Not a prediction in any shape, form, or fashion, simply a set of facts that tie the present day to this period, and this period. It's a weekly breadth indicator tied to the NASDAQ. It's volume-based in this case, chart date of February 12th. The last time we saw a move like this from A to B, here, back in 1982. Thus, if this move here is similar to this move here, off of the lows in 1982, February of 2021, similar to November 12th, 1982. From the date of the signal, there was a rapid and immediate drawdown in the S&P 500, but the S&P 500 was over 19% higher 1 year later, almost 20% higher 2 years later, over 40% higher 3 years later, and almost 77% higher 4 years later. That's what happened from this point here. The last time we've seen a move like this, 1982, never happened in here anywhere. It just happened in 2021. The example we just covered, breadth indicator tied to volume. Similar ideas here. This is the NASDAQ McClellan Summation Index. Made a new high here on February 16, 2021. The only other time we've been that high, looking at all of the data, here in 2003. Thus, February 16, 2021, right side of the screen is similar to June 12, 2003. This is a breadth thrust here. This is a breadth thrust here. From June 12, 2003, there was a rapid drawdown, 3.31%. This doesn't look like a big deal when you're watching this video. The stock market's dropped 3 or 4% recently. It doesn't feel good in real time. After this drawdown, if you remain cool, calm, and collected, really good things happen. From June 12, 2003 until the peak on October 9th of 2007, the S&P 500 gained an additional 56.75%. This is the monthly NYSE advanced decline line, end of February. Last day of February, it made a new high. That is significantly different from this period here, where it peaked 2 years before the S&P 500. It peaked in 1998. The S&P 500 peaked here in March of 2000. Similar situation here. It peaks early. It peaks in the first half of 2007. The S&P 500 does not peak until months later in October. Simply telling us this looks discernibly different from this. And the present day, end of February 2021, looks discernibly different from this. Doesn't predict anything, just speaks to odds. Covered this chart many times. This is the version we covered as of January 7th. This is the exact same chart after the 51-point decline in the S&P 500 on March 4th. We are still holding the bullish breakout. Here's a close-up of the credit markets in recent trading sessions. JNK IEF since February 10th. If we draw a line point to point to the close on Thursday, March 4th, we've been rising. The S&P 500's been falling. The credit markets don't seem to be as concerned as the stock market, at least thus far. Also noteworthy, S&P 500 peaked here. We've covered this divergence in the past. Ratio makes a discernible lower high. Right now, this is not a discernible lower high. We are running into resistance here. If you look over there, we'll see how it plays out. But this is not particularly alarming at this point. And once again, this speaks to default probabilities. You just have to think it through. Very, very similar situation here. You can pause your video player, but it's pretty fair to say the look right here looks significantly different from this waterfall decline look here that started before the S&P 500 peaked in February of 2020. This is the VIX as of Thursday's close. Don't want to spend a lot of time on this because I think it's indeterminate at this point. Keep in mind, when the VIX peaks and spikes sometimes, it's near an S&P 500 low. That's what these boxes show. But what we want to see in the present day, we want to see the VIX spike, come down, and the market rally. We don't have that yet in the present day, so this has some work to do. If this morphs into something like this, where the market is falling and the VIX is continuing to rise, that would increase concerns. We really don't have either of those scenarios as of Thursday's close. We'll learn something either way. NYSE advanced decline line. We've covered this topic in the past. I believe we did it near the October lows. Our concerns would increase if the advanced decline line broke this trend line. Wouldn't be the end of the world, but at a minimum, we should try to be patient as long as this trend line is intact as it was as of Thursday's close. NYSE Composite Weekly, couple of things to point out. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. That would be the good news from a probability perspective. This gigantic gap here might be the bad news. It's just good to keep in mind at some point this gap most likely will be closed. In this case, this gap was not closed for a very long period of time. Both of these items are on our radar, and once again, we'll learn something either way. GBTC, as of Thursday's close, has possible support nearby. Home builders versus defensive treasuries. Nothing particularly alarming here. This long-term breakout is still holding as of Thursday's close. Everything that we just said about the previous chart applies to small caps relative to treasuries. Momentum relative to the S&P 500 held here. We're back in the same area. We'll see what happens. This is RSP relative to IEF. Big drop in the S&P 500 on March 4th. Week to date, first 4 trading days of the week, This ratio is up 0.83%. This here looks discernibly different from this increasing fear look that started in January of 2020 before the S&P 500 peaked. This is almost the mirror image of this. This is high beta relative to low volatility. Compare this S&P 500 to this. This is what increasing fear looks like. This is what increasing economic confidence looks like. There's really no other way to say it. This is consumer discretionary XLY in isolation, kind of a mixed bag. We've broken this upward sloping trend line. We're back to this 61.8% retracement, possible support. And all of this is possible support. So we could get a move in this direction. The other concern, if we look at this on a relative basis relative to the market, that is also concerning, and it may drive decisions going forward. Here's an example of a concerning shift on a relative chart. This is a bullish breakout for RYT relative to the market. Now it looks like a failed breakout and a sharp reversal. The longer this breakdown holds, the more relevant it becomes. Remember, on the relative charts, doesn't necessarily mean that SOXX is going to plummet and go down. This just speaks to the probability of outperformance relative to underperformance. Still have some possible support in this area here, but once again, this is a tech-related issue that has a bullish breakout and now has a failed bullish breakout and is making a low. Why does this matter? This is a new multi-week high here, and immediately we're going down and making a new multi-week low. Typically, that's not what you want to see. This could act as possible support. We'll see how it plays out. SCHD is very, very similar to what we said about XLY. Some concerns here, some good things here, holding at this level here, which is the September high as of Thursday's close. The concerns would be more on the relative charts with SCHG. You can see the hold here with VUG a little bit better. Here's the close. We basically closed at the same level we closed at the September high. Back to the future. This portion of the video is being recorded at 5:15 after the close on Friday. The S&P 500 finished the session up 73 points and well off the session low. How do we do with the maximum drawdown chart that we covered earlier in the video? This chart is dated March 4th. You can see intraday we had a little bit of a scare, and then we rallied into the close sharply and closed at the session high well within the range of the historical norm, simply giving us additional reference points heading into next week. Also noteworthy from a trend perspective, we closed on Friday, March 5th above an upward sloping 50-day moving average and well above an upward sloping 200-day moving average. All of that speaks to the strength of the trend. And just as we reviewed the charts on Thursday evening with a flexible, unbiased, and open mind, it's incredibly important, if any of this is going to work, to head into next week with that same flexible and objective stance. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.